All right, let's go ahead and get started here. Thank you all so much for taking the time to join us today. My name is Mark Bolger. I'm the Agent Care Specialist here at Pinnacle Financial. I work with all the life insurance, final expense, long-term care, and annuity products. And today we actually have a special presentation from our rep over at National Guardian Life, who's going to be discussing a little bit of the ins and outs of their essential long-term care plan, which has lots of benefits that we'll be going over. Giving you guys a little bit of a 1,000-foot view of the product and why you should be offering this to your clients. So for those of you not familiar with Pinnacle, we're a national brokerage. We specialize in everything from life annuities, long-term care, final expense, simplified issue life products, as well as Medicare. So if you're interested in any of those other lines of business or other lines of products, you can certainly check out our website, pfsinsurance.com, and you can simply just go under products here and you can select any of these little subcategories here, and you can check out the carriers that we have available. So I'm just going to run down here real quick to the long-term care. A little bit of info about long-term care, some definitions here, and then we have a list of the carriers that we work with for the long-term care that are listed in here. So real quick, let me just kind of scroll down through some of these here. So as you can see, we have a few products, but today we're going to be going over this particular one, the National Guardian Life Insurance Company's Essential LTC. And those of you that are familiar with Pinnacle, that you can always, utilize our website 24/7, tons of different services and different resources that we offer here. You can certainly check that out here on our website under the Services tab, Agent Resources. You can also check out any upcoming webinars that we're doing. We typically host anywhere from 3 to 4 webinars per week. So there's a lot of information going on out there. And those of you that are registered for this webinar today, but unfortunately may have a scheduling conflict, you will automatically be emailed a copy of this webinar, and we'll certainly follow up with you to see if you have any questions and if you'd like to get contracted with this particular product. So with that said, just a quick intro on Pinnacle. I'm going to go ahead and I'm going to change the presenter over to Lawrence. This is Lawrence Vivenzio. He is our our local rep or national rep for NGL's Essential LTC. So Lawrence, I'm going to shoot this over to you, and you should get something popping up there. Let me know if you have any issues. Perfect. Yep, there we go.
Yes, seems to be firing on all cylinders, my friend. I appreciate the passing of the baton.
Looks perfect. You got it, my friend.
Very good. Very good. Well, hey, good afternoon, everyone. I appreciate you taking a little bit of time here to learn a bit more about NGL and Essential LTC. And really, those are the two things we're going to focus on. That was inadvertently our agenda here. I'm probably only going to take about 10-15% of our time, talk a bit about NGL, and then focus most of my time here really on the product itself. Bit of background on me. Everyone generally likes to know who they're talking to. I don't do a lot of bragging on me. I refer to myself as a long-term care lifer. This is actually all I've ever done professionally. I've been in positions similar to Mark's at agencies. I've been in positions similar to yours as field producers. I've worked for some large industry trainers, done worksite enrollments, consumer education and advocacy, various outreach things, and I just happen to be on the carrier side of the world now. So I like to make these conversational. So for those of you on the line, please type in the chat box if you have questions or comments as we're going along, and Mark and I will try and manage those and work those into today's conversation. I always feel these are more effective when we have a conversation rather than a presentation. So let's please have a conversation today about NGL and Essential LTC. So to begin with the first piece of that, when I was out there selling, I usually found consumers wanted to know 3 things about a company. One is how long have they been around? 2 is what do their financials look like, and 3 is how are they rated. So I summed that up pretty quickly, and with one paragraph with any carrier I was talking about when I was selling. And in NGL's case, that summary is, hey, you're talking about a mutual company that's been in business since 1909. They've been around over 110 years. They're A-rated by AM Best, which AM Best considers an excellent rating, and they have roughly $5 billion in consolidated assets. So generally, those 3 things put a consumer's concerns at ease. With regard to long-term care, we have a very clean balance sheet on long-term care because we entered the market in 2016, which was after, coming from the perspective of a long-term care lifer, after our industry learned a whole lot the hard way about long-term care, right? Because these policies really only got popular in the, I argue the mid to late 80s, and they gained a lot of steam in the 90s. But at that point, we really didn't have any claims data for actuaries to use. So up until, in my opinion, roughly 2010-ish, we were still taking a lot of guesses when it came to pricing, when it came to underwriting, and really understanding where we needed to be on those 2 fronts with these policies. Today, we've got a pretty good idea of where we're supposed to be on those 2 fronts with regards to traditional long-term care. So NGL is in a great position. We don't have old legacy business that was poorly underwritten or mispriced or had bad assumptions with regards to claims. So we're in a very strong position, having partnered with an administrator who's been doing nothing but long-term care for over 3 decades. And we have a very clean balance sheet on our book of business. Coming from a mutual company that's been around forever with solid assets and an A rating, I think it's a best of both worlds type of scenario. So the result of that was a product that I think you'll find to be very competitively priced, with some very interesting, rich, and flexible features that other traditional products just don't have. Things you haven't seen in years on traditional long-term care. Because today we know how to underwrite. We know how to price this thing. And it created a very flexible, moldable product that you can tailor to what your client is saying is important to them. So before I delve into product, by the way, marketing owes me a new map because we are now available in Montana as well. We are available in all states except New York. Okay, so New York is the only one that should still be gray. Montana was just released about a week and a half ago. So product is available everywhere right now except New York. I do this quick bit on availability because that's always the first thing to type in the chat box. Where's the product available? So with that, that's my nutshell on who is NGL. And I said I'm only going to spend about 10-15% of my time with you on us as a company. If you have any additional questions, I'm happy to field them. Again, please type them in the chat box. The rest of my time, I really want to focus on the product. What makes it unique to the marketplace today? And a couple of sales ideas where I've seen top producers having some great success with this. And, this session, I believe, was marketed to those who were versed in long-term care and you've already sold some long-term care. So I'm going to be doing some competitive analysis as well, and likely to other products you've already sold. They'll remain unnamed, but you'll probably pretty quickly know who they are. And I'm hopeful you'll find that helpful as you decide, which arrow is the one to pull out of the quiver in certain client situations. So if there are 5 things that make this product very unique to today's marketplace, I would say they are the 5 on the screen. Don't feel like you have to write them all down. I'm going to go through each one individually, beginning with the first. I truly believe that if you're talking to a couple today about long-term care planning and you don't bring up this product, you are leaving a compelling option off the table. Pretty bold statement, but I believe it to be very true. And I'm hopeful in about 2 minutes you'll agree with me. So on your screen now you have Mr. and Mrs. Insured. If you got another traditional product on the brokerage marketplace today, you have to sell them each their own policy. They each have their own policy number. They each have their own premium. You have to then add up their premiums so you can then tell them what they're going to pay every month or year or whatever it might be. We tried to simplify that in creating one joint policy. That's represented by that rounded rectangle on your screen. So that joint policy has a joint premium. There is no part of that premium that belongs to either one of them. So naturally, if either one then is receiving benefits, that joint premium in its entirety is waived. So it created an automatic joint waiver of premium, which for other products you would pay extra for. Now within that joint policy, you still have those two blue circles. Those now represent completely and totally separate pools of money. He's got his, she's got hers. There is no circumstance where they will ever touch each other's pool of money. Even if one dies, their pools are their own. Now, you'll see our shared rider we didn't call shared care like the other products on today's market do. We called it a shared benefit amount rider. Why did we call it that? Well, it's a separate third benefit amount. Now you have three blue circles. So in the example of a 3-year benefit period, you have three 3-year pools of money or benefit periods on this screen. Whereas with competitive models, you would just share each other's policies. So how might this work? Well, let's say Mr. Insured goes on claim and he uses all of his benefits. Remember, he can never touch hers, and the reason for that is because he could then tap into that shared third benefit amount. If he needed all of it, he could use all of it. But let's use an example here where he uses about 80% of it, and then he passes away. Well, Mrs. Insured, here's the beauty of this, still has her full benefit amount left. He didn't leave her with just a year or two worth of benefits because remember, he can never touch her pool. So if she then goes on claim and uses all of her benefits, she can then follow a similar path and use anything that was left in that shared benefit amount. So it is a third pool of money available to either or both of them once they exhaust their own pool. So I truly believe if you were talking to a couple about long-term care planning and you don't bring up this product, you're leaving a compelling option off the table. And that's really just from a benefit and flexibility standpoint. Because I think this thing truly provides the ultimate flexibility when it comes to claim time for couples. Now, on this next slide, I want you to focus on the bottom first, which I know is counterintuitive. Don't look up at the top yet. The bottom puts our 3-pool model versus the 2 separate policy model you'll find in other brokerage products next to each other. That is a $225,000 difference in available benefits on day one when this policy is issued. And if you look up towards the top of the slide in the black font, we're also about $1,200 a year cheaper. So, again, if you were talking to a couple about long-term care planning and you don't bring up this product, you are leaving a compelling option off the table. Now I can also say that from a premium standpoint, not just a benefits standpoint. This, if you take anything away from this, I think is going to be one of the most, one of the biggest takeaways you can have from this product. If anyone has any questions about this, please type this in the chat box. In fact, I just had one pop up. What is the ideal age range for marketing this plan? Typically market from 40 to 60, and I find that no one over 60 is able to qualify. I would generally say you're in the right age range. I would go a bit over 60. You know, I'd say where the decline rate really starts shooting up is around 70. It does shoot up a bit around 65, but the 60 to 64s are going to have a similar acceptance rate to the 55, 59s. I don't think you're going to find too much variance there, at least based on the data I've been keeping track of for our business. But your ideal marketing age, I would say, would be 45 to 65. Average applicant is in the upper 50s. Sometimes in the 40s, you just run into, other focuses in life and affordability issues, etc. So you're definitely in the right neck of the woods.
Right, exactly. And just to chime in too, Lawrence, I get that question a lot, and I usually say exactly what you said. The 45 to 65 market is typically where you want to focus. Again, you might get some in that early 70-year-old range where they can still get through, but in my experience with just running some quotes and talking to agents about their clients, I get a lot of people calling with clients that are 78, 79 years old. So a lot of times that's where, you want to make sure that you're doing your fact finding. You want to make sure that if they really need to be in pretty excellent health at that point, which unfortunately, in my experience, they, at that age range, it's very, very difficult. But sorry, go ahead.
Oh yeah, no, just at any age, be diligent in your fact finding. Believe me, we don't want to decline your business. We'd rather help you and pre-qualify and let you know ahead of time.
Exactly.
I will tell you, north of 70, underwriting does become a challenge. A lot of business is written in the 60s, so don't count out just 61 plus. A lot of business is written in the 60s. But from a sales perspective, here's the way I would put it to people, and I hope this gives you a tidbit that leads to some more applications. When a consumer would ask me, hey, well, when's the right age to plan for long-term care? I would say, look, I hate salesy non-answers, but you're going to get one. So my salesy non-answer to that question is, I know people in their 20s who will never qualify for long-term care insurance for the rest of their life. Only good health can buy you long-term care insurance. So when's the best age to buy? Whatever age you are, when it is affordable to you and your health allows you to buy it, that's when you should buy long-term care insurance. Don't wait. I have seen too many horror stories where people are uninsurable for the rest of their life, and then they end up needing care years down the road. Buy it when your health allows you to and it's affordable.
And real quick, we just got another question in here asking, is the shared benefit amount rider, is that automatically included?
No, it is a rider. So you can buy it without that shared third pool. You can just get a joint policy, but the rider is an additional option.
Gotcha. Makes sense. Thank you.
Yeah, not a problem. So let's talk about some other interesting features. I'm the only traditional product on today's marketplace with a lifetime unlimited benefit period. It will truly never run out. As long as they need care, it is an unlimited pool of money. You also have choices between a 2, 3, 4, 5, or 6-year benefit period in addition to the lifetime unlimited. Lifetime is expensive because there is an unknown amount of risk associated with it. For couples, if they're considering lifetime, say they had a very, very long claim in their family history, a good way to combat that, upcharge for the lifetime is to use, say, a 5 or a 6-year shared. Costs a whole bunch less, and statistically, most couples are not going to burn through, for example, 15 years worth of care. Some will, most won't. In 15 years, that would be using the 5-year benefit period with the shared 5-year pool, 3 5-year pools. So it's an interesting option to put up against lifetime. But for the singles, or for the couples who just truly want to pay for that ultimate peace of mind and knowing that come anything, they're never going to run out of benefits, it's a great box to check, and I'm the only traditional carrier where you can check that box. I'm also the only traditional carrier with a single premium payment option. It will be fully paid up on day one. We will never ask for another penny, and it can never get a rate increase. It becomes non-cancelable on day one. Okay. I'm also the only traditional carrier with a guaranteed premium on a 10-year premium payment option. It can never, at any point, even during the 10 years, get a rate increase. My 10-year pay works like that in all states except California. California, you could potentially have an increase, but only during those 10 years. I also have a lifetime premium payment option that works just like all other long-term care insurance you are used to selling. Okay, so you have flexibility in the premium payment duration in addition to the benefit features. So it goes back to that theme of a very flexible, moldable product that does what your client wants it to do and makes it the things that they are saying are important to them. So if they're concerned about rate increases, yes, on the lifetime, I have a good story to tell because, again, we have a very clean balance sheet on our long-term care block of business. But if they want an absolute guarantee of the premium, you have two ways to do it, and that's with the single and the 10-year pay. Let's see, I got another one popped in the question box here. Most companies do not offer rate increase history. What is the history on rate increases with NGL? We do not have a history of rate increases on our long-term care business. There has not been one in-force increase. I do not have the crystal ball to guarantee that that will never happen because my contract does not say guaranteed when it comes to the lifetime pay, but it does when it comes to the single and the 10-year pay. So really interesting ways to address your client pushbacks and customize this plan to be what's important to them. I've also got ways to create benefits at death and surrender values to compete with hybrid models. So, you talk about some of these things, right? Lifetime benefits, single pays, guarantees, benefits at death. Sounds a lot like these asset-based and hybrid or linked benefit, whatever lingo you like to use, types of products. But I can do it all on a traditional chassis, creating that same value proposition. If you need care, there could be a benefit. If you live, right? If you die and you don't need care, there could be a benefit. If you think you might even consider canceling this thing, there could also be a benefit. And I do that with return of premium riders. For those of you who've been selling long-term care for a while, you remember these from other products of yesteryear. Well, we still have one. I just talk about it differently today. And how it works is you look at premiums paid, you look at any benefits received as long-term care claims, subtract one from the other. If there's anything left, that amount goes to the beneficiary. So 10, 15 years ago, we said, don't sell this, just buy life insurance. It's cheaper. But over the last 10 or 15 years, these combination products got very popular. So I look at this equation on the screen today and I say, hey, isn't this exactly how a hybrid works? Just that first stack of money is called a death benefit instead of a premium, isn't it? And that's reduced every dollar by long-term care claims paid. And if anything's left, it goes to the beneficiary, right? It's the same thing, just different language. And of course, if the claim is much larger than the premiums paid, in that case, the beneficiary would get nothing. So that's how I talk about limited return of premium today. I also have a version that works just like what's on your screen, but it adds a surrender value that grades up to 80% of premiums paid, and it stays there on the 4th anniversary and the rest of the life of the policy. So what I like about this is you have flexibility and its efficiency in the sale, because you can take one product out and display the traditional concept or the hybrid concept. You don't have to talk about different companies, different product chassis, different ways to do it, different financials, all that. You can pull one brochure out of the briefcase and have both conversations. And you have more flexibility because you can just check a box and this can be a live-only policy. Check another box and it's a live-die policy. Check another box and it's a live-die cancel policy. Flexibility, moldable product to address what's important to your client. So that's my nutshell on product features. My first sales idea would be to talk about it in an asset-based kind of a way. And when you put the two next to each other, many people usually lean towards the traditional long-term care when they see the value and benefits for the premium dollar. We can display a little bit more of that a little later if anyone wants to see some rate examples. The next idea I'd like to talk about, and I will address this briefly, It's just that we do have a program for the work site, and where I see it fitting best is these small, closely held businesses and executive carve-outs, because we do all of this on a traditional chassis. There's no part of this that is life insurance. So you can sell these rich benefits like 10-year pays, return of premiums, and in many business scenarios, it could be completely tax deductible, which you can't do on life insurance. So I do have a unisex employer group rate class. It's available to all of our issue ages, 40 to 79, age nearest. Our group approval is very simple. Our minimums are as low as possible. There is no commission hit on the unisex rate class. And the reason all that's so simple is because we will still fully underwrite the individual. That's why getting the group set up is easy. We're not going to underwrite the group because we're going to underwrite the person. And it gives you access to that unisex rate class and list bill if you need it. But again, don't forget about the potential for some tax advantages here, because with these features, doing it all in a traditional chassis, we can have some really interesting conversations. Even if it's just a business owner buying it on himself and his spouse, and they cut the check, well, you wouldn't have enough for a minimum for a group, but that business could potentially still deduct it. Just depends on how they're set up, C versus S, etc. So some really interesting conversations can be had there. I also want to talk to you all a little bit about 1035 exchange. Bear with me, though. I have a couple more things come in the chat box. Let's see. Oh, this is a comment. I think this product is excellent and can't wait to offer it to my clients. I'm as excited as you are for you to do that. Couldn't be happier to hear that. So thank you for that feedback. Let's see. The next one asks if can a company fund a policy on behalf of the employees and get some tax benefit? Yes, absolutely. As we just discussed, I think you probably asked that as I was talking about it, so my timing there was impeccable, which does not happen often. So yes, we can definitely have some very specific conversations there. Just need to know how that business files their taxes, whether they're a C, they're an S. Generally, when a business buys it on a non-owner employee for an S, it is completely deductible. For a C, even if it is on an owner, it is completely deductible. Owners of an S gets a little bit more interesting. We can delve into that. I could do an entire webinar on taxes, but whatever the scenario is you have there, bring it to us and we'll chat about it.
Yeah, guys, these are great questions.
In there
too. Yeah.
I already answered my question, so perfect.
Yep, keep these questions up, guys. These are excellent. Sorry.
No, not at all. I love it. Like I said, I want it to be a conversation, so I appreciate that. Okay, so 1035 exchange. Let's do a refresher on what we're allowed to do here. With the advent of the Pension Protection Act, you can take, most people forget this about annuities, you can take non-qualified annuities and 1035 them into long-term care. You can also take cash value life insurance and 1035 them into long-term care. And I'm talking the entire thing, even the gains that they never paid taxes on. And when it pays for long-term care, the benefits that come out the other end are tax-free long-term care reimbursements. They never paid taxes on the gains in the original policy. You want to talk about some exciting stuff? This is one that gets a lot of people pretty excited. Because you really waved your long-term care specialist magic wand and turned a potentially taxable asset into tax-free benefits. Okay, stuff to look out for. Middle box. I have to have what's a like-for-like exchange. So if it's a couple and just the husband has life insurance, I can't stick that into joint insured long-term care because I don't have like-for-like insureds. But I've got ideas for you. So don't feel like you've hit a brick wall if that happens. Especially if it's an annuity, then I have even more ideas. Single person, this isn't something to worry about. First bubble. Keep in mind I cannot do this with an annuity that's set up as an IRA. If it's qualified money, I can't touch it with Section 1035. It has to be a non-qualified annuity. Bottom bubble. Remember, if you're selling single pay LTC, you're selling guaranteed premium traditional long-term care insurance. It's guaranteed to never get an increase. Pretty great scenario. Only traditional carrier you can do that with is NGL, because we're the only ones that have a single pay on today's marketplace. Now, I want to share with you some sales strategy, because I promised you I would. Well, I already have throughout, but I like this one in particular. So this is really a culmination of what a lot of advisors did successfully that was observed out there in the field. So once you've financially and medically pre-qualified somebody, you say, look, Mr. Client, I can help you in one of two ways. I can help you transfer the risk of possibly needing care to an insurance company, and you pay them this thing called an annual premium for it. Or I can help you do what you told me you wanted to do, which was self-insure. But what if I told you I can do it better and longer than you'd do it on your own? Would you mind if we discuss both of these options? Now, what I said sounded pretty simple. There were a lot of very specific things that went into that piece of conversation. If you look at the two words on your screen in quotation marks, I basically said, Mr. Client, I can get you a traditional policy or a hybrid policy. Do you want to talk about them? Sounds real different, doesn't it? So there's a lot of subtle sales psychology that went into the statement. Mr. Client, I can help you in one of two ways. I've already done two things. I said I can help, and I provided options. You're more likely to get a yes when you use both of those items. Then you explain the options. I can help you transfer the risk of possibly needing care, right? Go back to the whole pitch of long-term care. I'm not saying you will, because none of us ever want to think we will. But if you did, the consequences could be devastating to your family, financially, physically, and emotionally, right? And if you did, that risk goes to the insurance company and you pay an annual premium for it. Or I can help you, you're helping again, do exactly what you wanted to do. Now you're helping him achieve his goals. But I could help you do it better and longer than you do it on your own. Now you've piqued interest. How can he do it better than me? I don't know. So when you get to, would you mind if we discussed both of these options? Rarely did I see advisors say no or get a no when they presented it in that manner. So here's what's next. Well, Mr. Client, generally when people tell me they want to self-insure for long-term care, they have some money set aside in something, and that's their self-insurance. Usually it's a life insurance policy or an annuity someone bought many moons ago for different reasons than why they have it today. For example, you got a life insurance policy 35 years ago. Now you're retired, your wife is retired, you're both on your retirement income, the house is paid off, the kids are out of school, and you don't have any debt. You don't have that life insurance policy for the same reason today. Only reason you have it today is to self-insure your long-term care risk. Well, I promised you I could help you self-insure better and longer than you could do it on your own. So let me take that life insurance sliver of your pie and pack it into this little vehicle called a 1035 exchange. I just made that little piece of pie much bigger. And that new large piece of the pie could be all tax-free long-term care reimbursements. Or if you think for a second you might die and never need this, which, by the way, chances of one of the two of you needing care is astronomically high. For any individual, it's greater than a coin flip. But if you are concerned about that, and it's worth the extra benefit premium to you, I can return it to that original sliver if you die and never need this. If you even think for a second you might consider canceling this thing, I can give you 80% of that sliver back on or after the 4th anniversary. One of my favorite things about this slide is the image that marketing picked to put on there. And look at the clients. Because that was the look that I'd see on people's faces when advisors would present this the right way. They would ask questions like, how come no one's told me about this before? What kind of policy is this? Is this even legal? How do you build a policy to do this? Well, for everyone on this call, it's the stuff we already talked about. If you live and need care, which should be the primary focus, you can create a policy with lifetime benefits or 3 benefit pools. If you are concerned for a second that you might die and never need care and the rest of the premium is worth it to you, you can add a return of premium. If you think for a second you might cancel this thing, add a surrender value. Just kind of where I end, where I began. We have some very compelling features built into this product. that will allow you to flex and mold this thing into what your client says is important to them. These are just some of the sales ideas that can come along with some of these features. But there are a whole lot of scenarios where this product fits the situation very, very well. Let's see, I have my chat box going again. So please, if you have any other questions, feel free to type them in. Let's see. Oh, this is a comment. Love the single premium option. I've been looking everywhere for this. Well, good. I'm glad you have found it, and I wish I found you earlier. So, hey, I also want you all to know that there is a great way to quote this thing in about 15 seconds. That is with our quick quote calculator. The Pinnacle team, I'm sure, can send this out to you after today's session. Please don't try and write down that URL. Inevitably, someone misses a dash or a slash or a dot, and the whole URL doesn't work. But I'm not kidding. You can run a quote in about 15 seconds. It is that easy to use. If anyone wants to see a demonstration of this, just let me know, and I'd be happy to type this in. With that, I could pass the baton back, and any questions, ending comments, or anything you want me to go back to, it would absolutely be my pleasure. Just my closing remark would be I truly appreciate you taking your time today away from what keeps your doors open, which is talking to clients and selling, to learn a bit more about NGL and Essential LTC. I want you to know that we are here to be true partners with you. Anything you need, we will not stop at much of anything to give you the best service in the industry and earn your business regularly. We absolutely want to be partners with you in your long-term care sales and do all we can to get your business in the door, processed efficiently, and provide you the best service to you and your clients that we can. So we would appreciate the opportunity to work with you at that level.
Excellent. And certainly appreciate you taking the time to join us today, Lawrence. That was an excellent presentation. I think we had quite a few agents learn some things, and I'm getting some messages here on my email saying, hey, send this over, get me set up with this. Sarah, one of our agents, just said, excellent point with the joint coverage. The chances of clients needing this drastically increases. That's an excellent point. She says she offers joint life, LTC, and med sup plans, and it is always the best option for clients, as she said, because one of them is definitely going to need it. If not, more than likely going to need it. So being able to offer this to spouses, certainly is a great value for the clients. Let me just see if I had anything else on here. Said, love the single premium option. I think you did read that. Yeah, guys, any other questions? I guess we'll give them maybe like another minute or so. Guys, feel free to type in your questions, and I'll give you guys like another minute or so, and we'll see if we can grab some more, and I'll read these off to you here, Lawrence, in 2 seconds. As soon as I get these in. Here we go. I got a question. Let's see. What is the difference between qualified and non-qualified LTC coverage? I think you did talk about that earlier.
So when I was speaking about qualified money, I was not speaking about the LTC coverage itself. Any product
right.
in today's market, to my knowledge, is a tax-qualified LTC plan. I think you were talking about qualified versus non-qualified funding sources for 1035. So in the case of an annuity to be used by 1035, it must be a non-qualified annuity. So the money that goes in is stuff they've already paid tax on. If it was pre-tax money, like an annuity that was set up as an IRA, I cannot use that in Section 1035. So I hope that answers your question.
Gotcha. Yeah, no, that certainly makes sense. And let's see, did I get any others in? This is kind of typical, but kind of tough to answer. But what health issues and age group would be like knockout or hard to place scenarios? I think we did kind of cover this in the beginning, where we were saying your target market should be in like that 45 to 65 range. Again, anybody in their late 70s, you run the risk of, having multiple health issues, and, the chances of the cases, qualifying at that point, kind of diminish a little bit. But again, like Lawrence mentioned, and like we mentioned in the beginning of the call, you always want to make sure that you're doing fact finding, regardless of the age of your client. I can't tell you how many times for life insurance, people have done their own fact finders, for the health portion, but they forget the lifestyle questions, or to ask them that. And I've seen, just things kind of, get passed around in underwriting and delays the cases and things like that. So, perfect. Yeah, I think that was an excellent question. Let me just see if I have anything else in here. Sweet spot age where NGL is most competitive. Again, I would say probably in that, in that 45 to 65-year-old range. We obviously have.
Yeah, when it compares to other products, if that's what that question was getting at, we
that's
have
what
a pretty large delta, pretty large premium delta south of 70, 72. Once you're up in the 70s, it starts getting much closer with the other carriers on the marketplace.
Sure.
Sure. But for couples, pretty much at any age, we're going to knock it out of the park. The singles will start getting closer around, those upper 70s. But there are a whole lot of scenarios where we are just very, very competitive today.
Yeah, absolutely. And those of you that are on the call are definitely familiar with our LTC quoting software that's on Pinnacle's site, which actually allows you to, it'll show all the companies. And every time I run the quotes, I always see NGL, either the first one or maybe, in the top 2 or 3, almost every time. So, and then Lawrence said that they have their own microsite here where you can run just the NGL quotes instead of, seeing, some of the other carriers and stuff. So certainly, utilize that. We'll be sending out some marketing material on this to everybody that's registered and who attended the call, and we'll be following up with everybody to see if you guys want to get set up with this company. I think a few of you might already be contracted, but we can certainly reach out to you to see if there's anything we can help with. And again, we certainly appreciate you here at Pinnacle Financial for all the hard work you guys do out in the field. We certainly appreciate being your partners. Same with NGL. Every company that we work with, we consider everybody to be partners, and we all want to work together to help each other as much as possible. So we certainly appreciate everybody for taking the time. Again, we'll send a copy of the recording with some materials after the call here. And guys, if you have any questions, feel free to reach out to myself here at Pinnacle, Mark Bolger over in the Life Department, Bill Vandergrift. You guys are pretty much all familiar with us, everybody here on the call. So certainly reach out to us if you have some additional questions. I can relay those over to Lawrence if needed. And then, we'll certainly get you guys, set up and running here. So again, appreciate everybody's time. Lawrence, thank you so much again. And we look forward to writing some more business.
Absolutely. Thank you very much for helping set this up. Thank you again, everyone on the line. I can't tell you how valuable your time is to us and how much we appreciate it. And we definitely look forward to getting some business processed for each and every one of you, and appreciate the opportunity to show you what we can do. So with that, have a wonderful afternoon, everybody.
Thanks so much. Everybody take care. Thanks again.